Over the years, when it comes to the gold and silver ratio, I have consistently railed against the standard arguments for its use. Some of my biggest arguments against the gold to silver ratio as a buying guide or investment framework really comes down to three main issues. One, the gold to silver ratio solely looks at price and doesn't consider premiums. And until recently, premiums on an ounce of silver was around 15 to 20%, while an ounce of gold was around 4%. My second issue is the ratio looks backwards for the historical context, but that doesn't account for the real shifts in silver's industrial usage, which is more than 50% of its demand, and that number is only increasing. Finally, and third, is the ridiculous argument that somehow the ratio by which it's pulled out of the ground should determine the price ratio compared to gold. That argument is so flawed that it makes my head hurt. There are much rarer elements that come out of the earth that are worthless. Why? Simply because they don't have a use case. If the ratio out of the ground made so much sense, why don't we use that argument when it comes to platinum, oil, uranium? Because it doesn't make any sense. The stupid hypers use it in hopes of you just blindly accepting it so that you feel better and buy metals from them. That aside, that's not what this video is about. Today, let's focus on the portion of ratios in your stacking and wealth journey. Because while I bash the GSR a little bit, I do believe ratios are critical for our investing success. Whether you recognize it or not, ratios are a fundamental tool or calculation that we use in almost every aspect of life. So much so that it's overlooked. From investing and finance to engineering, ratios give us key information and insights into relationships between different quantities. As I showed in the previous video about platinum, the power of ratios is their ability to simplify complex data in order to help us see trends, compare assets, and particularly compare those assets over time. Whether you're a seasoned investor or you're just getting started out, understanding these ratios can make all the difference in your investment decisions, particularly as it relates to finding opportunities. Regardless, here's what you need to know when it comes to ratio. One, life is about equilibrium or the average, be it average height, intelligence, or net worth. Knowing the average allows you to understand where a ratio is relatively. For example, in the gold to silver ratio, the average of the ratio since 1971 is around 60 to 1. That number is important because when you know that the gold to silver ratio is currently in the 80s, that tells us that we should expect the GSR to return to the historical average or the mean, which is 60 to 1. As investors, we can use this information to say it's better to buy silver because in order for the ratio to turn to 60 to 1, silver will outperform gold. That's the general assumption. Two, ratios help you understand range of price, value, and valuation of two items over time. Continue with the GSR theme. In March of 2020, when the GSR reached around 125 to 1, it did go as low as 17 to 1 in April of 2011. So if the GSR is at an 80 to 1, does that mean that it has to come back down to 16 to 1 right away? No, it doesn't. It could easily go back to 125 to 1, or it could go as low as 17 to 1, which is the key next point I want to make. While ratios can tell you whether something is over or underpriced, it doesn't tell you when or why a ratio will move in either direction. What it does tell you is the next point, point number 4, ratios help you understand the historical risk and reward of a particular investment at a particular time. And 5, ratios also give you an insight into the technicals of the market in one indicator. More on that in a moment. Please do not miss this point. While ratios provide you with a historical context, that does not speak to the current conditions in the market and whether they favor the ratio increasing or decreasing. When I talk about market conditions, I'm talking about the overall macro environment, and most importantly, the specific variables that influence the price of either asset. The clearest example is what we just witnessed with central bank buying gold over the last few years. We witnessed how central bank buying buoyed the gold price while silver prices languished over that same period of time. While we can talk about ratios, especially the gold to silver ratio, what no one really talks about is how we can use the ratio in a variety of assets to help us find investment opportunities. When Rick Rule talks about buying assets that are hated, another way of thinking about this is looking for assets that are historically undervalued. In other words, where the ratios are at extreme. Obviously, when the GSR was at 125 to 1, silver was a no-brainer because how cheap it was in comparison to gold, and you knew it would have to go back to that historical average or the mean. But let's move away from gold and silver for the moment. If you've been around this channel for a while, you know that once you have your physical gold and silver stack established, I'm a big supporter of investing in commodities broadly, be it uranium, oil, copper, lithium, and nickel. You probably heard me talk about our need to invest in commodities because of the tremendous value they present. But why do I feel so strongly? How do I know that this is the case? Take a look at this chart of real assets to financial assets over the last 100 years. As you can see, this is at a historic low. Remember, ratios tell you where you are, they don't tell you when. This means ratios can't be used in isolation, and this is why I mentioned the market conditions earlier. Either way, be it you using ratios to confirm what you see in current or future market conditions, or using market conditions to confirm what you see in the ratios, they have to be used together. This is why I talk about platinum being potentially better than silver in terms of performance, because silver is cheap to gold and platinum is cheap to silver. And in a high inflationary environment, platinum performs better than silver. That's how I come to that conclusion. I just showed you this real assets to financial assets ratio, but let's look at the ratio of commodities to equities. What does this tell you? That historically speaking, commodities are cheap. Does that mean commodities will go up? Yeah, but does it mean it will do it right way? No. Ratios don't tell us time, but the market conditions of debts, deficit, interest rates, and money printing tells us it's a matter of time. When you start to understand these ratios, you can start to position yourself where you want to be when the tide turns or when money starts to rotate from sector to sector. I really started to focus on gold, silver, and commodity stocks back in 2021. And boy, was I early. I had to endure some of my positions being cut down 60 or 70%. I knew I was right. I knew I was early, but it didn't stop me from feeling like I was making the wrong decision. Fast forward today, and I couldn't be much happier. That extra time gave me the opportunity to continue adding to my physical stack and slowly build my stock position. It allowed me to enjoy a pretty nice run in uranium, and I'm in great shape to make what Rick Rule calls the easy money in gold and silver stocks. How did I know back in 2021 that mining stocks were a great opportunity? Several things about ratios. One, the gold to the S&P 500 ratio, as you can see on the screen. Look at that. What is it telling you? Two, look at the gold to treasuries ratio. How about the silver to treasury ratios? How about Barron's Gold Mining Index to the gold price ratio? You can even take a look at the Huey to the XLE ratio, which is gold miners to oil ratio. All of those ratios told me that it was inevitable, but not necessarily imminent. I knew it was imminent or just a matter of time because the market conditions told me that and confirmed what I saw in the charts. Ultimately, regardless of where you use them in your life, ratios are powerful when it comes to helping you determine value. I don't care if you're comparing two different sizes of potato chips, the ratio is measured in price per ounce, and that is what tells you where the value is. Just as the gold to silver ratio tells you where the value is when comparing gold to silver, or commodities to equities, or mining stocks to the price of the metal. Ratios are invaluable. While I didn't discuss this directly, please don't overlook that these same ratios also tell us when our investments are overvalued, and therefore give us a potential range of when we should start to sell or start to take some profits off the table. I strongly encourage you to start exploring using ratios to help you identify opportunities as well as threats when investing. If you'd like to hear more about how the wealthy use ratios to change their lives, write more ratios in the comments. Speaking of which, in the comments section, do you use ratios in investing? If so, which? If there's something else about ratios you'd like for me to cover, go ahead and put that in the comments, or simply put an A+ in the comments to let everyone know that you always stack smarter and never stop learning.